First of all, thank you for the opportunity to speak to you today. In the next 20 minutes or so, I'm going to give you what is actually a very simple presentation, which basically proposes the thesis that people with not much money will be affected when the economy changes and interest rates rise. And for those of you who are lending money for a living or have businesses that rely on people who lend money for a living, that is going to cause problems. And an understanding of how many vulnerable people you have in your businesses or in your credit portfolios will be useful as you try and tackle the problems that will inevitably arise. So, just by way of background, the financial crisis and the recession that we've just come through has highlighted a number of things, some of them on the macroprudential side about the behaviour of credit markets more generally and the health of banks, and secondly, at the other end of the scale, that credit portfolios are made of people, and some people fared very badly throughout that process. So the regulatory community is very interested in ensuring that as we move forward, then consumers do not suffer detriment, in the jargon, as a result of their interactions with financial services providers. And just as an aside, my organisation Experian is currently going through the process of applying for FCA regulation, and a lot of that is about the avoidance of consumer detriment in the work that we do. So ultimately the objective is to write fair and sustainable business that treats the customers properly and ensures that credit portfolios and businesses related to those have a healthy future. And the tricky bit is getting it right in between, collecting the right data, having the right systems to make the right decisions which enable businesses to flourish, but also ensure that consumers are treated fairly and will be able to maintain their relationships with you through into the future. So when we look at the motor finance sector from the sort of data that we collect, it's doing pretty well. There's been good growth over the last few years, and delinquency rates are lower than they have been in the past. So all in all, that's a reasonably positive outlook. And as it says there, the time to fix the roof is when the sun is shining. So this is a good opportunity to look at many of the processes and systems and the sort of data that you collect that you might be able to use to help you moving forward. So before I do that, I just want to spend a moment talking about a tool which I will rely on later through this presentation. And this is a segmentation tool called Financial Strategy Segments, which basically carves up people along two dimensions. Firstly, life stage, so how old people are, broadly speaking, or what stage of their lives are they at. And then secondly, affluence, how much money, wealth, disposable income, call it what you will, they have. And we can segment the UK population along those two axes, and they fall into those coloured boxes. I won't explain some of the more flowery names in each of the boxes, but basically bottom left is young people with relatively little money, top right is older people with relatively more wealth. As I say, I'll rely on that as I go through the rest of this talk. So if we look at the motor finance sector in general, it's a pretty stable position. So what we're looking at here is the distribution of new lending by each of those segments. And while those three bars are not identical, they're pretty close. So the distribution of people applying for finance over the last few years has not varied very much, and that's probably no great surprise. When we look at that by region as well, again, using the data that we collect at my organisation, again, no huge shifts geographically in the applicant profile applying for motor finance. So if we think about the wider economy, how do we think the economy will play onto the UK population when we have to balance things like potential rises in mortgage rates. And I've been giving this presentation now for 3 or 4 years, and I always start by saying interest rates are going to go up soon. And I haven't been proved wrong yet. Oh, sorry, I haven't been proved right yet. They haven't gone up, but I heard a guy from the Bank of England this morning said that they're going to go up in the not too distant future. So there's some comfort in that. But at some point, they will rise from their historically low levels, and some people will be squeezed. So it's going to be very useful to have an understanding of people's disposable income so that you can offset that against the likely pressure that they will face going forward when their credit commitments rise. And the interesting question is, who within your portfolios will be most vulnerable? How many of them are they? Where are they distributed? Whereabouts in the country are they? Whereabouts in the risk profile, if you're using credit scorecards, for instance, where do they fall? And what is the likely impact in terms of losses as you look forward? So again, some of them, it's a fairly obvious statement to make. Some of them will have less income than others. So again, this graph here shows the monthly disposable income by some of those segments that I showed you earlier. So the left-hand side, accumulated wealth, these are the older, more affluent people, and they have a higher disposable income. And the difference between the two bars is the average UK population with a mortgage, and the blue is those people with a mortgage and a motor finance agreement. On the right-hand side, you've got the traditional thrift. These were people with lower affluence, and it's no great surprise that they have less disposable income. And there's a couple of explanations of what those groups are. So accumulated wealth, affluent families, highest incomes. I mean, you can fill in the gaps yourself. Traditional thrift, older people reliant on benefits. And we're in an environment where benefits have been squeezed, and as a result of last Thursday's election, they're going to be squeezed even further over the next few years. Pay has not really been growing very much over the last few years. So on this chart, what we have is the lower two lines are essentially pay, regular pay and total pay. And the upper line, the purple line, is the CPI inflation. So as you can see, inflation rate has been much higher than income growth over the last few years. We're in the slightly unusual situation at the moment where, because inflation is at zero, we actually do have some income growth, but that won't persist. Oil prices are already going up, and inflation is on its way up, and wage growth is still fairly anemic, while productivity in the economy, again, is not growing, and that's an issue that's been called out by a number of commentators. So wage growth is not really very strong, so that's going to be a drag on people's ability to afford credit commitments if the economy turns sour in the future. What we have here is the relative risk of those groups. So what I've done here is taken the overall motor finance market and defined 0 as the average arrears rate in the motor finance market in the data that we hold. So if you remember the earlier slide, let's say for the sake of argument that's 0.7%, an average delinquency rate of 0.7%. And then what we have to the left is delinquency rates which are worse than that. Sorry, better than that, I apologise. And to the right, we have delinquency rates which are worse than that. So the top bands are 1.5 times worse than average, or higher delinquency rate than average. The bottom bands are lower delinquency rate than average. No great surprises. The people with the stretched finances are at the top of that table. They're the ones with the highest delinquency because they have the least money, they have the least capacity to absorb stress. The wealthier people at the bottom have more capacity to absorb stress, therefore they default less often. The question is, within your portfolios, where is your portfolio distributed across that scale? If you're all in the bottom, fantastic. If you're all in the top, it's probably a problem. In reality, you'll be distributed. You'll have different compositions, different concentrations within each of those groups. Do you understand what those concentrations are, and do you understand how those people react as the economy changes? This is a variation on the same theme. So this is nominal discretionary income by affluence group, quoted per week. And again, what we're seeing is that the discretionary income, the slight downward trend over recent years. And again, the same message is that people with relatively little money will be vulnerable as the economy changes. The other thing to bear in mind is that the regional distribution of these people, so don't try and squint at this, I apologise for the quality of the graphic. On the left, what we have is household disposable income mapped nationally. On the right, we have the unemployment rate. And again, different parts of the country will have higher unemployment rates as a result of the local economy in that area. And again, when you overlay your credit portfolios against that geography and that unemployment rate, that's going to give different views of arrears and potential losses. So when you're trying to understand the impact of all these variations, it is very important to try and get as good a view of the customer as you can. Many of you will have a very good view of the repayments that the individual makes on the agreements that they have with you, and you may well get information about their wider commitments from a credit bureau. It is very useful to have a full view of what the commitments of those people are, because that will help you assess potential losses going forward. So as I've said, when interest rates start to rise, then this is going to put the squeeze on some people. And again, what I've got here is the impact of a 200 basis point rise in interest rates on average income, split out in a bit finer detail through that segmentation that I showed you earlier. So again, if your portfolio is concentrated to the right, then the impact on average income is good. As interest rates go up, people with lots of savings are going to get more interest income, so they will do relatively well. People on the left with very little savings, perhaps lots of credit commitments, they're going to feel the squeeze. And again, where are your customers on that spectrum, and what is the relative concentration within your portfolios of those customers? So there's lots of data available to help you understand concentrations within the portfolios that you're running, and it's relatively straightforward to forecast forward the impact of the economy on those concentrations. And you will have areas which are particularly vulnerable, and you will have areas which will do relatively well. So to support that sort of activity, it's important to capture the right data up front. And again, net monthly income or monthly income is a very useful thing to capture from customers, because it gives a reference point against which to compare. And it's important to satisfy yourselves that the income stated is real in some senses. There is no unique source of income data that's validated in the UK, so it's a matter of getting something from the customer and then trying to validate that as best as possible. Household status and number of dependents is useful because in trying to model disposable income, it's relatively straightforward to get credit commitments. You can estimate housing costs. Discretionary expenditure is more difficult. There is no source of data for the whole population about how much we spend going to the cinema or dining out at restaurants, so we have to rely on modelled survey data available from the government for that. Most of you will have automated decisioning systems for onboarding new customers, and it's relatively straightforward to amend those systems to capture this sort of data and build it into a slick automated process which not only looks at credit risk but also looks at affordability. And then you will all have processes for managing exceptions to that process. So really, sorry, one thing I should have said at the beginning was that the regulatory pressures not only to assess affordability at the point at which you're originating customers to satisfy yourselves that yes, they can afford it and this is the right arrangement for them. There is also pressure to do that throughout the life of your arrangement with that customer. Again, so there's a premium placed on understanding your customer base, understanding how their circumstances will change in the future, because at some point you may have to have a conversation with them about difficulties that they might get into. So I just want to spend a moment looking at some of the data that's available for assessing income. So the banks, some of the larger banks share what's called current account turnover information. That's where the acronym CATO comes from. And that is information about the credit turnover in current accounts. So if you're paid, if the sum of your credits in a month is 1,000, then that's the current account turnover on that. That is not a true reflection of an individual's income, but it's a reasonable guide. And again, in the business of income estimation, a reasonable guide is about as good as you can get, absent detailed information from people like HMRC, and that data is not available. You can also estimate income using credit bureau data, and again, it comes back to the position of some sort of reasonable estimate. So if you have lots of financial commitments, a large mortgage, relatively large limits on your credit cards, then there's a correlation between that and the income of the individual. It's not perfect, and it's not absolutely accurate, but it forms a good guide. So putting that into an originations process, for those of you who originate, who support credit activities, then first thing to do is to check the income stated by the customer. And again, some of you will be asking income up front, some of you won't. Once you've satisfied yourself that this customer is in the right ballpark in terms of their affordability, then there's the usual credit check. Are they a good credit risk or not? And then put that all into a final ability and assessment of their ability to pay now and into the future as well. So, in conclusion, affordability is nothing new. Questions about affordability and responsible lending have been current in the market for at least the last 10 years. But the crisis that we've just come through in the recession has heightened the focus on that, both from the competent management of credit portfolios perspective, but also from the regulatory perspective, and what are the consumers that you're dealing with getting good outcomes. And I would say that a good consumer outcome is not always necessarily what the consumer believes to be a good outcome for them. You know, often a decision to say no is in the best interest of the customer. Clearly the customer might disagree with you on that point. It's good practice to sell products to individuals that are suitable for them and that they can afford, and that are not going to incur you credit losses going forward. And as I say, it will underpin the sustainability of credit businesses into the future. Okay, thank you very much.
Paul, just one thing before I put it out to the audience. It's interesting, as my colleague Pat will know, we're doing some research at present into the US auto lending sector, and they're absolutely obsessed over there with the fear of defaults growing. As a result of having their fingers bitten in 2008, 2009. And they scrutinize every single bit of information that they see, particularly on subprime lending. But at present, you say, for us in the UK, that's in the future. At present, levels are quite steady.
So those numbers that I showed you were the finance industry, the arrears rate for the finance industry as a whole, and it's an average.
Right.
There is variation around that average, and there will be sectors of the market where it's considerably higher than that, and there will be sectors where it's lower.
Specifically on automotive at the present time, then, what experience of it? Levels keeping.
Yes, in the aggregate, as I said at the start, there's more lending happening now than there was 3 or 4 years ago, and delinquency levels in the aggregate are much lower than they have been in the past. Okay. So that is a relatively healthy picture for the sector. Yeah. Clearly, when you go to the subsector level, then there will be organisations who are doing better and worse than that.
Right. Good. Fine. Right. Questions for Paul? Right. Can we have a mic, please? Right, Nigel, if you'd kindly introduce yourself and your company.
Thank you, Brian. It's Nigel Williams. I've been involved in the industry for many years. I'm interested actually because there's a lot more visibility from consumers about their credit data, and Experian are one of those organisations that make that more visible. Yesterday, as late as yesterday, Martin Lewis was advocating to people how they can actually manage in the short term their sort of credit status. So, in light of that, how robust is what you're doing when at the other end of the scale people are trying to sort of manage it in the short term?
I think it's still very robust. I think, we ourselves are in the managing credit score business, and through our credit expert service, we provide a lot of advice and guidance to members of our service and also to the wider public about how they can improve their credit score. So make sure you're on the voters roll, make sure you repay your credit commitments. I think that's good advice, and for people who have a habit of not paying their credit commitments, if they change their behaviour and improve their position, then their score will improve, and that's a good thing for the industry, and it's a good thing for those because it will give them access to products that they can support. And I think Mr. Lewis is offering the same sort of advice from what I've seen from him in the past, so I don't see that as a problem. There are organisations out there, and there are less of them today than there have been, who offer services around improving your credit score by doing some things which could undermine it. That's relatively small, and they have been clamped down on by regulatory authorities, and they're not as prevalent as they were 3 or 4 years ago. It's still a very, very small problem, and the sorts of credit scores that we and our competitors in the industry provide are still robust and safe, as is the data provided to them.
Okay, Nigel, does that answer your question? One more? Great, at the front. Thanks, Colin.
Thank you. Andrew Slatford from Hitachi Capital. Experian's expertise in credit scoring and evaluating the probability of delinquency, arrears or default is one dimension of asset finance in lending to consumers or in providing car finance to corporates. The other dimension is the value of the asset, the collateral, and the loss in the event of a default. What would Experian see as the glue that would bind those two hemispheres of risk together, and how would Experian go about delivering a service that not only looked at the default probabilities but the loss probabilities as well?
Okay. So we and companies like us do offer those services, and for those of you who are familiar with banking regulation, the Basel Capital Accords have this idea of regulatory capital, so how much capital you need to hold to protect yourself against unexpected losses when they arise. And the way that you get to an understanding of those unexpected losses is by assessing the probability of default, the loss given default, and the exposure at default. So it is linking the propensity to default against the ultimate loss. And it is possible to construct decisioning systems, and in fact that capital regulation encourages lenders to do that through something called the use test. So what the use test says is that you should use the same tools to make your granular decisions about individual consumers. You should use the same tools to make assessments about the health and the capital position of your portfolios. And basically the way that you do that is build essentially a two-dimensional model, one of which captures the probability of default, the likelihood of falling into arrears or default, and coupling that with the ultimate loss that occurs. And if you are in the fortunate position of having an asset, then that asset is used to mitigate the loss in the event of default. And then, having got those two dimensions, you then construct a decisioning system subject to a number of constraints, like how expensive is capital, how much capital do we have. You construct that decisioning system to control the flow of individuals into your portfolio, subject to those broader constraints around capital.
Andrew, does that answer the question?
It does. I suppose my curiosity is why Experian doesn't provide an analytics service within its range of products on asset values, particularly when you have the double witching hour or triple witching hour of falling asset values when interest rates rise by 200 basis points and you experience more defaults and repossessions.
We do provide those services. I'd be happy to have a conversation with you outside of this room about that, but we absolutely do.
Paul, thank you. We'll have to leave it there because the witching hour for coffee is coming up, actually. Paul, thank you very much for that. That's absolutely terrific.